Here's the real reason that Bitcoin is crushing that nobody's telling you. Bitcoin is already down by 30%, wiping out over $1 trillion worth of market cap. But this crash is very different. It's not like any other crashes that happened in the past. This crash is not made by your typical Bitcoin trader. This crash is orchestrated by the likes of BlackRock. During the pandemic, they took over the real estate, buying massively single-family homes. They took over the stock market, and now it seems like they're coming for your Bitcoins. The total assets that are under the management of BlackRock is over $12 trillion. The total market cap of Bitcoin is less than $2 trillion. So they literally have all the money they need to just buy Bitcoin and take full control over it. So the real question comes at the end of the day is, why is BlackRock interested in crushing Bitcoin prices? Let me explain. The ownership of Bitcoin over the last couple of years has been slightly changing from retail investors into the hands of institutional buyers. And that's primarily since January 2024, because the SEC approved ETFs that could invest in crypto. An ETF is basically an exchange-traded fund, an organization that takes investors' money and invests it in a certain sector. They would not invest in a single asset, but rather in a diverse assets. So there is an ETF that invests in the S&P 500, there is an ETF that invests in real estate, there is an ETF that invests in crypto right now. They will take all the wealth that is there in the world, and a small portion of that money, by investing it in this ETF, would go into crypto. In this case, the total value of their investments is about $250 billion. So BlackRock was the first to jump into this boat by launching their iShares BlackRock ETF, but Fidelity also joined the game, and there is about 5 to 10 major ETFs that are launched by the largest money managers. And that created a new baseline demand for ETF. You can see that starting from January 2024, the price literally just kept growing, and it hasn't actually gone below that level where this ETF was launched. What is driving this crash is that these ETFs have doubled their gains and are now cashing out. It seems like a very good investment. They bought it at $44,000 and they cashed out at about $125,000. BlackRock sold $2.2 billion of crypto, Fidelity about $1 billion, and in total, these ETFs sold about $3.8 trillion. And most of that happened in November, but primarily in October, which led to the massive crash in Bitcoin. The problem with crypto is that nobody actually knows what is the true value of crypto. If you ask Bitcoin enthusiasts, they will tell you, oh, the price of Bitcoin should be at least $1 million per coin, or maybe $1 billion per coin, or maybe $1 trillion per coin. But there is no justification why. Yes, Bitcoin has actually its value because there is a huge network of people that use Bitcoin. But how do you measure it? Because the way we measure any kind of asset is based on how much money that is generating. If you take a piece of real estate and it's generating $10,000 annually and the valuation metric is 10 to 1, then the true value of that real estate is $100,000. If we're measuring a stock, we know behind a stock there is a real company, and we look at the earnings of that company. If the valuation is 20 to 1 and the company is making $1 billion, then the value of that stock is about $20 billion. So what is the value of Bitcoin? What is the framework that we have to use to measure Bitcoin? And when institutional investors get into any kind of assets, they need logic in order to drive their investing decisions. They might not be always the best investing decisions, but there is always like a framework on how to value a certain asset. And because there is no framework for Bitcoin and is very speculative, yes, the price of Bitcoin is growing because there is demand. There are people buying it. But why people are buying it? Some people say that Bitcoin is replacing the dollar, which is not true because Bitcoin is not used as a currency. You can't use as a currency Bitcoin because its price is fluctuating so fast. To replace the dollar, you have the stable coins. And Bitcoin is like a speculative game that you buy just because everyone else is buying it. The price is rising, which is actually letting you to profit out of it. But even selling about $4 billion of Bitcoin should not have caused the Bitcoin price to plummet by 30%. But Bitcoin is over-leveraged. Traders are using ratios 10 to 1 or even sometimes 50 to 1. So if you get into a position and your position is worth $100 and you're using a leverage of 10 to 1, even if the price of Bitcoin goes down by 10%, yes, in theory, you haven't actually made any kind of losses unless you sell your investments. But because your ratio of leverage is 10 to 1, theoretically, you just lost $1,000. So your broker liquidates your position and you lost your entire $1,000. So when a big player such as BlackRock gets into the market and they sell $4 billion and your leverage position is, for example, 20 to 1 or 50 to 1, you automatically lose your entire position just because the price of Bitcoin went down by 5%. And because you lose your position, it increases the supply of Bitcoins in the market. While the demand for it is very limited, it amplifies that losses. So whenever there is a lot of leverage in the market, it amplifies any kind of fluctuations. In the stock market, you can actually have a leverage position of 50 to 1. The highest that you can go is probably 3 to 1 or maybe 4 to 1. If the market wasn't that over leveraged, then that crash would have been by 5% or 7% in the best case scenario. But the real question here is that why did BlackRock suddenly decided to sell its Bitcoins now? Think of global wealth as the one giant pool of money that moves in the same direction. There are trillions of dollars worth of wealth, and it's controlled by the largest banks, by hedge funds, ETFs, sovereign funds, you name it. And those trillions of dollars must be invested somewhere. If you keep it in form of cash and there is inflation, then that wealth is getting evaporated every single day. And that's why you as a money manager, such as BlackRock or Fidelity or Vanguard, your first job is to preserve that wealth, and your second job is to make slightly a return that is higher than inflation. So if inflation right now is about 3%, then you're looking for returns that are above 3%. And you have different asset classes where you can invest that money. You can invest it in the safest investments, such as the US Treasuries, or you can park it at the Fed, just let your money at the Fed, and the Fed will generate you interest for keeping your money at the Fed. Or you can invest it in the stock market, or maybe you can gamble a portion of it in very risky investments such as cryptos. Up until late 2023, a big portion of that money was parked at the Federal Reserve. The way that the Fed controls inflation is that it takes liquidity out of the market. So when inflation is high, the Fed can increase interest rates. Now there is an incentive to keep your money at the Fed because you're going to generate as much interest rate as the effective interest rates there in the market. So large banks, instead of offering loans to people and businesses, they would rather take that money, keep it at the Federal Reserve and generate 5% or 5.5%. So liquidity dries up in the market, there is less spending in the market, which slows down spending, which slows down inflation. And vice versa, if the Fed wants to inject money into the economy, it is going to lower interest rates. So banks don't have an incentive to keep their money in the Fed if they will just generate 1%. Better take that money and loan it to people and businesses, let them actually do something with it, and you will generate a much higher interest rate. So starting from late 2023, a lot of that money has been leaving the Fed, and the total amount of the reverse repo has reached $0. Either that money is going to go into the safe havens such as the US Treasuries, or a portion of that money could go into the stock market, and a small portion of that money is going to go into risky assets such as crypto. They're essentially gambling because, again, there is no definitive method on how you can measure the value of Bitcoin or any crypto in general. That liquidity gets into the market, which is going to create the demand, which is going to push asset prices. It's even clear that starting from 2023, the price of Bitcoin began to rise. It actually hit a rock bottom of about $20,000. And since then, it has been rising to $125,000. But a bigger portion of that money has been falling into the stock market, which is why it reached a rock bottom back in March 2023 at about 3,800 points. But since then, the stock market essentially doubled. So the first problem right now is that all that cash has actually left the Fed and is already injected into the economy. So no more cash actually left to leave the Fed and get into the market, which is one of the main reasons why the markets are slowing down. The second reason is that risky investments such as Bitcoin are the first assets that institutional investors are going to sell whenever there is any kind of crisis. Because we don't have a really good framework to measure their valuation, we're actually gambling. We're just speculating on what the price of this asset is going to be. So we don't have that framework. There is a crisis, we're going to sell them and take that money and throw it into a safe haven such as the US Treasuries. So the real question is that, are we on the brink of another crisis? Well, there are obvious signs that the economy is headed into a recession. We don't know how bad that recession is going to be. Unemployment is rising, jobs report is actually going down, there are massive layoffs, especially by tech companies. We thought that we are in this AI boom, but that AI boom is slowing down. I mean, we have largest companies in the economy such as Nvidia, Apple, Microsoft, Meta. All of them has already announced massive layoffs. There is also a slowdown in spending. Consumer sentiment is going down. So everybody knows that we're getting into a recession, but nobody knows for a fact when that recession is going to happen. So that creates uncertainty. Usually the government steps in order to save the economy. The government is the largest spender. It is collecting trillions of dollars in taxes. It is borrowing trillions of dollars and spending in the economy. But then the government says that, listen guys, we are going to shut down, so no more actually spending. What message do you think that is sending to the economy? What message does it send to the market? It's like we no longer have the largest spender in the economy, which is the US government. That creates more uncertainty, which forces institutional investors to sell more of their riskier assets. In fact, if you look at the massive sell-offs of Bitcoin, it perfectly correlates with when the government shut down. The government shut down on 1st of October, and since then, the massive Bitcoin crash actually started. I mean, the government has already opened back its doors, but it just recently happened. It was literally the longest government shutdown in history. The third reason is that chances of a rate cut in December has actually plunged. Whenever the economy gets into a recession, the Fed steps in by lowering interest rates. And everybody was like, oh, there is 100% chance that the Fed will lower interest rates in December. But the probability of that has gone down to like 40% or 30% because we haven't actually controlled inflation yet. If the Fed keeps the rates at the exact same level, then maybe it's much better to park your money in the Fed and generate about 3.7% in interest rate. It could also mean that we're heading into a recession, but at the same time, we don't have the option of lowering interest rates. And this is a way worse situation, which investors never want to see, which is another reason why large investors has cashed out and doubled their gains. I mean, they made a lot of money. So large investors such as BlackRock and Fidelity triggered the crash with their massive sell-off. But at the same time, because the market is over-leveraged, it amplified that crash, which is why the market is crashing. If you want to know where the market is headed to, then you have to understand how big money is making their investing decisions. And there is a specific framework to do that. So if you're new to investing and you want to understand better investing, then there is a fully animated video right here somewhere on the screen that will literally teach you everything you need to know about investing.